essentially, if you have something along the lines of a limited liability corporation, you get to elect how you want to be taxed. My name is Edward Collins, and today we're going to talk about the real wealth matrix. What is it, and why do you need one? Well, I designed this concept about 14, 15 years ago now, and it's really a structure, a game plan, a roadmap with how you go about structuring your financial life and the businesses that you have so that you do and accomplish two things. One, you help to protect the wealth that you work so hard to create. And two, you structure your businesses in such a way that it actually helps facilitate the reduction of your tax burden. You see, in the United States, the tax code is pretty complex, but at the end of the day, if you structure things the right way, it's simple to reduce your tax burden. May not be easy, but simple it is. Let's get to it. The real wealth matrix starts off with understanding how do you actually lay out the businesses that you have. And I'm going to give you a general scenario at a high level view to help you basically gain an understanding of what I'm talking about. I like to start everything in your financial life with trusts. Now, there are different types of trusts that exist, but there are really two main categories of trust. There are something referred to as revocable trusts and something referred to as irrevocable trust. An irrevocable trust is something that once you form it, once you create this trust, it can never be changed. Now, I'm a lawyer, so the word never really comes into play because there's always little nuances. But for the most part, just think of it, an irrevocable trust cannot be revoked. The revocable trust, on the other hand, is something that you can create today and you can modify it as your life and circumstances change. So what I'm talking about here at this level, I'm talking about revocable trusts. And the benefit of having a revocable trust is it's a legal structure by which you own assets, and those assets can be controlled on your behalf. God forbid if something happened to you. Whether you lack competence, meaning you're not cognitively capable of making decisions for yourself at some point in time, whether that's through disability or injury, or you're unconscious in general, where, again, due to a disability or an injury, you're not able to actually manage your financial affairs. A trust is a capsule in which all of your assets are owned, and then you appoint other fiduciaries to be able to facilitate the management of those assets on your behalf when you are incapable of doing so. But we start off with trust because the trust is going to own all of your personal assets, the things you normally have in your own name right now, things like your bank accounts, your investment accounts, let's say, your non-qualified investment accounts, things like your automobiles, your boats, and your personal real estate. So personal real estate, like the home in which you live. A trust is going to be the owner of all of these types of personal assets. Now, again, the reason why you want to do this is because you want to have a management structure in place. God forbid if you are unable to carry through with the management of those assets at some point in the future. So the management structure takes place. The other benefit of having a trust handle all of these assets which otherwise would be considered something called a probate asset, is that the trust, in essence, becomes a will substitute for you. So that doesn't mean you don't need a will in your estate plan, but the trust owning everything avoids these assets from having to go through probate. And depending on which state you live and which jurisdiction you find yourself in the United States, probate can be quite an expensive process for your heirs to have to go through. So avoiding that helps to save your heirs a significant amount of money down the road. 100 years from now, when you pass, your heirs won't have to deal significantly with the probate process because the trust will be able to carry on your behalf once you have passed away. Now, the other thing that we want our trust to own is we want our trust to own something called a holding company. Now, the reason why we want to set up a holding company is we want there to be a stepping stone between all of the different business assets that we may own and ourselves. So having a holding company be that entity which owns all of the other business assets, that creates enough of a barrier between you and those assets to help protect yourself from things like litigation, specifically through a process with regard to how you actually structure the business itself. So what type of business entity do you select to be your holding company? Now, there are a variety of ways to actually set up a business. You can set it up as a sole proprietorship. You can set it up as a general partnership, meaning you and another individual or a series of other individuals get together to form a business, but you don't actually operate it under a legal business structure. You're just operating it under a partnership environment. You can use structures that state law has created, things like limited liability companies, C corporations, S corporations. These are a variety of the different types of legal structures you can put in place to actually form that business and to actually function that business within. Now, it's important for me to note here what the difference is between a legal structure and a tax structure for your business. So a legal structure is actually how you form the entity based on state law. So every state in the United States has its own laws regarding corporations and businesses, and each state has its own little nuances with regard to how you actually form those businesses from a legal standpoint. All that means is it has to do with the structure of the business. However, beyond just the legal form of the business, you also have the tax form of the business. So you have legal, and then you have tax. Under the sole proprietorship environment, you really don't have any options. You're being taxed as a sole proprietor if you set up a sole proprietor relationship. So your only option is to be treated as a sole proprietor. That's the only way you can have it work out. Under a general partnership, it's very similar. General partnership, the only way to have it taxed legally is as a general partner. Again, you have one or more other business partners beside yourself. Each of you individually are being taxed as general partners of that particular business. Another way to do it is if you have a LLC, a limited liability company, and in some states there may be limited liability partnerships, there may be professional limited liability companies. There's a variety of different nuance per state, but essentially if you have something along the lines of a limited liability corporation, you get to elect how you want to be taxed. You could be taxed as a sole proprietor if it's just you as the one member of that limited liability company. You could be taxed as a C Corp, or you could be taxed as an S Corp. So the limited liability company gives you a lot of nuance with regard to how you actually elect to be taxed. Then with regard to a C Corp, you're going to be taxed as a C Corp or an S Corp, and an S Corp as a C Corp or an S Corp. Again, it's an election that you make on your tax returns. Basically, you file a form with the IRS to tell the IRS, this is how I intend my legal structure to be taxed going forward. Now, there's a lot of reasons why you may elect one version of tax treatment versus another, and in this video, there's not really enough time to go into all the nuance, but what I can say is this. We cover a whole lot of this in future videos here on our YouTube channel, but we're also going to be covering it in a variety of our different programs that are available in the up-level entrepreneur ecosystem. So if you're not part of that ecosystem yet, you absolutely need to jump into it so that you can stay informed as to what's going on and what opportunities are coming up for you to learn more about how to properly structure your business. But let's get back to the real wealth matrix. We talked about the trust and setting up a holding company. Depending on where that holding company is situated, meaning where is it domiciled from a legal standpoint, because you are permitted, if you live in one state, to actually form a company in a different state. It does not have to be a state in which you live. You can form it in another state. And some jurisdictions actually lend themselves to having much more leniency towards asset protection strategies. And what I mean by that is specifically in the realm of anonymity. So when I'm talking about anonymity, I'm talking about, does the state publish to the public who the individual owners are of the business entity that's formed within that state? Now, there are really three states which are pretty ideal when it comes to anonymity and asset protection. One of them is Delaware, another one of them is Nevada, but the one that I tend to like the most right now is Wyoming. And the reasons for that is it gives us anonymity, meaning if you've done things the correct way, if you structured the business the correct way within the state of Wyoming, set up the right registered agents and notified the state of those individuals who can receive notice on your behalf, if you've done that the correct way, then the state of Wyoming does not publish to the public your specific name as an owner of that business. So it gives you anonymity. So the benefit of structuring your holding company in a state that provides for anonymity makes it so that it becomes much more difficult for a lawyer who has an incentive to find out whether or not you own certain assets, to determine whether or not you are someone who is ideal to litigate against, to basically to sue. If we can't find any of the assets that you own, lawyers tend to sit back and say, is this a worthwhile case for me to take on as a litigator in order to try to find recovery for the clients that they serve? Now, again, doesn't mean it's foolproof, because someone who is more than willing to invest a significant amount of time, effort, and resources to litigate against you, they're going to do that. But what I'm talking about here is establishing what I refer to as a roadblock. Now, in asset protection, there are two things you have to think about. One is the shield, or the force field. That is the legal structure of that entity. What structure have you put in place to protect that entity and the assets it owns from outside forces, whether they be creditors, litigants, or even dear old Uncle Sam? So that's the legal structure. Now, the other quality of asset protection has to do with what I just mentioned, which is anonymity. So not only are you putting a shield around you, almost like having a force field, whether you're a Star Wars fan or a Star Trek fan, having a force field around the assets that you own, and specifically the businesses, if you will, that you own, but also adding almost like a cloak of invisibility that you would find in one of the Harry Potter stories. Because if they don't know that you personally own the asset, you have an added layer of asset protection. Again, it doesn't in and of itself create asset protection, but it creates a roadblock from which individuals are not able to even see the things that you own, specifically the attorneys who may be involved in litigation potentially against you. So having the holding company, where it may be situated, where is it domiciled, that has to do with the legal structure, but really it has to do with the domicile in which that legal entity is formed. That creates the anonymity aspect of it. So again, we have trusts set up to own all of our assets, personal assets and our business assets. So the trust owns our holding company. Then our holding company could be the entity that owns our assets, our business assets specifically. And there are two general categories of business assets. You have active business assets. Those are the businesses that are actually engaging in activity on a daily basis, and you may be involved significantly in those daily activities. And then you also have passive assets. And again, passive in this regard just means that you're not actively engaged in the day-to-day operations of that business. Doesn't mean you don't actually work in the business, it just means that you may not be actively engaged in the day-to-day operations. Now, a little nuance, the IRS oftentimes will consider for tax purposes a business that's associated with rental real estate, whether that's residential real estate or commercial real estate. They automatically, no matter how much time you're putting in, they automatically consider that to be passive unless you meet a very specific standard that the IRS has in place. Now, in order to be considered active, the IRS says that you have to be engaged in that business activity for 500 hours per year. If you're not meeting 500 hours per year, you definitely cannot be an active business. It's not going to be considered an active business. You're going to be a passive owner in that particular business. And I'm going to get into why you want to be active versus passive in just a moment. But just know that it is a very, very important qualification and distinction. On the passive side of the spectrum, not only would you have to meet the 500-hour minimum, the IRS has essentially carved out real estate investments to be separate from pretty much all of the businesses by putting in an added step. For you to be considered an active participant in that business, you also have to be deemed to be called a real estate professional. Now, here's the little bit of a mistake I see a lot of individuals make. They believe that that term real estate professional means that they have to be a realtor. And that's not what the real estate professional status means. It just means you are engaging in the business of real estate, a specific business of real estate, to the degree that it exceeds what would normally be considered active over here to the tune of 750 hours plus, so 750 hours per year, plus you also have to have more than, so greater than 50% of your activity, your business activity, must be in real estate in order to make the real estate investments that you have and the business of real estate that you have transition from being a passive holding that you have to becoming an active holding. So it's a little bit of a nuance. Why is this important? I'm going to break it down for you pretty simply. In business, one of the biggest profit leaks that you have is tax. As a business owner, you're constantly struggling with how to make sure that you're optimizing your overhead, whether that's payroll, whether you're optimizing your marketing budgets, whatever it may be. But the things that often get overlooked are the taxes that you're paying because you're not really focused on them until the end of the year. And in fact, not even the end of the year, you're not focused on them until April 15th of the year following the end of the year. Now, the challenge with that is these profit leaks that you encounter, they siphon away significant amounts of resources that you potentially could either personally enjoy or redeploy into your business. So when it comes to tax planning, when I sit down with businesses and business owners and I try to help them navigate the tax code, what I'm often trying to do is help them figure out how can they minimize and pay the absolute minimum they're required to pay when it comes to taxes. And we do that by being able to take advantage of deductions. Not only deductions, but deductions, credits, and exclusions from income. And I talk a lot about this in some of the other programs that we have available through Uplevel Entrepreneur. But here, what I want you to understand is that there are different ways to reduce your tax burden, and they fall typically within one of three different categories or some hybrid of the three. Again, deductions, credits, and exclusions from income. Now, the benefit of real estate assets is it gives you the ability to take a very large, potentially a very large deduction that's not really an actual expense that you have in your business in the year you take it. And that is referred to as a depreciation expense. So again, it's really a paper expense. It's not something that you're literally writing a check for on an annual basis. But if you own real estate, you get to depreciate a portion of that real estate that you own. Essentially, let's use an example. If you own a piece of real estate that, let's say you, and again, I'm going to use a very simple example to make it as easy as possible. If you own a piece of real estate that maybe is $400,000 when you purchased it, but the land component of that real estate comprised about $100,000 of value. So the improvement, the house that you own, was $300,000. The IRS allows you to write off as a depreciation expense, essentially, that amount, that $300,000, periodically over a period of about almost 30 years, 27 and a half years. So almost 30 years. So essentially, over a 30-year time frame, you would be able to write off a portion of that expense every year, approximately $10,000 a year of depreciation expense. Now that's not a one-time write-off. That's a write-off every year over that 30-year period. Again, it's going to work out to a little bit more than $10,000 a year of depreciation expense. But here's the kicker. In a recent tax law change, the IRS essentially gave you the ability as a owner of rental real estate, or whether that's commercial real estate or residential real estate, they gave you the ability to do something called bonus depreciation, or to accelerate the amount of depreciation that you have for that piece of residential real estate. Instead of taking that once a year over the course of about 30 years, they allow you to take that depreciation all in the first year. So essentially, in this example that I just gave you, you'd be able to bonus depreciate $300,000 of depreciation expense which could offset your income. However, here's the kicker. Expenses that are clearly on the passive side can only be used to offset passive income. They can't be used to offset active income. So if you have $300,000 of bonus depreciation, but only, let's say, $20,000 of residential income from the asset that you own, you'd only be able to take $20,000 of an expense that year. You get to carry forward the remainder, but that's not as powerful as I would like. Again, I'm looking to figure out how I can help my clients and the people that I serve reduce their tax exposure to pay the absolute minimum that they're required to pay. So here's the tactic. You do what's necessary to change that particular type of investment that you have from being a passive investment to becoming an active investment. And you do that by becoming a real estate professional. So real estate professional. And once you become a real estate professional, now all of the expenses that are associated with that formerly passive asset can be used to offset the active income you may have within the other businesses that you have. In fact, it can be used to offset any earned income at all. Let's say you have W-2 employment. Let's say you're a medical doctor that has a medical practice and you're taking a salary from that particular position. You have a large W-2 amount of income. Formerly, you would not be able to take that passive income and offset your medical salary. But once you are able to move that asset from passive to active status, you're able to then take that massive loss, again, just a paper loss, it's not really dollars out of your pocket, and offset income that you have on the active side of the spectrum. This is huge, huge, because it gives you the opportunity now to capture and recapture the wealth that you've worked so hard to create and redeploy it how you see fit, not how the IRS determines. And definitely not how the United States government thinks it's appropriate to redistribute the wealth that you've worked so hard to put into your own pocket. Now, this is where it becomes part of the overall real wealth matrix, however. This holding company would then go out and become the owner of all of the other businesses that you may have. Now, you may have businesses that are related businesses. Maybe they're, again, let's use the example of a medical practice. Maybe you own your own medical practice, and maybe you also own a medical billing company. So again, maybe there are two different related active businesses that you own. You can also have unrelated businesses, maybe businesses that you own just for diversification purposes. So again, maybe you're a medical doctor, you own a medical practice, you also own a medical billing company, but then maybe you also own a laundromat. Again, the whole concept of this is these are just on the active side of the spectrum if you're actually engaged in at least 500 hours of activity within each of those individual enterprises. But then maybe you also own some residential real estate. Maybe you own a commercial piece of real estate. Maybe the building in which you're running your medical practice you own as an investment asset. Again, normally these would be considered, for the most part, most individuals would have these situated in such a way that they would be passive holdings. But if you're able to do the things that are necessary in order to shift yourself from, and again, here's another cool little tip, you don't have to become the one who is the real estate professional. If you are a married couple, your spouse can qualify as a real estate professional, and that bleeds over to the entirety of the return. So as long as one member of a married couple is a real estate professional, the entirety of all passive income or passive losses could potentially be applied towards active income in order to reduce your tax burden. But again, the holding company is the entity that owns all of these separate businesses. The question is, what is the structure that you use when it comes to setting this up? Well, again, there's a variety of structures legally that you can use to form the holding company. Same applies to these other business assets that you have. Whether it's an active business, it could be a sole proprietorship, it could be an LLC, it could be a C Corp, S Corp. Whether it's real estate, I'm going to say that, again, you could potentially own it in a variety of ways, but the vast majority of financial professionals will tell you, if they've done their own due diligence, that almost always the ideal form of ownership for a real estate asset is going to be under an LLC. And typically, if you're owning it individually, owning the LLC as essentially as a disregarded entity for tax purposes, meaning there's no separate tax return that this LLC forms. It literally just funnels everything up to the holding company, and the holding company becomes that entity by which you're actually filing your tax returns year in and year out. Now, this is just a snapshot into the overall real wealth matrix, and the nuances for each individual is going to be different, depending on what's going on within your financial life, what types of businesses you own, how active you are within them, what's the level of risk exposure that you're involved in within that particular business. And again, as an example, if you are a plastic surgeon, you are much more likely to be the target of potential lawsuits than if you simply owned laundromats. Doesn't mean you wouldn't be exposed to lawsuit, but it's unlikely that you'd be the same level of a target than if you were actively engaged in medical procedures for individuals. Now, there are a variety of ways to help offset that risk exposure that you have. And in fact, one of the number one forms of putting a shield in front of you between you and creditors and litigants is to have the properly structured insurance in place. But beyond that, ensuring that your entities, the way you've formed your businesses, how you've structured them legally is important. How you operate and run those businesses on a regular basis, whether or not you're doing your regular meetings for that entity, whether you're having your annual meetings, if it's a certain forms of business structure, you're actually required to legally at least meet once a year. But meeting often and making sure you're documenting the operations of the business and the decisions that you're making, all of these things are part and parcel to being able to ensure that you have the most amount of protection in place. Because one of the things I've learned this myself, and I've learned this vicariously through others over the course of the past 20 plus years. No one wants to have to get wealthy twice. So if you put the right risk measures in place and the right structures in place, you can make sure that you're doing the things that help offset challenges that potentially could come down the road. Now, it doesn't mean you're going to avoid all of them, but you want to make sure you are at least wearing a seatbelt, God forbid, if you get into an accident. I hope this helps you, and I wish you well in your journey. And again, if you have not yet jumped into our ecosystem to learn more about what we do and how we do it, what are you waiting for? Can't wait to see you on the inside. Bye for now.